reporting investments, I don't want you to think this is confusing or anything. It's confusing. There's no way around it. So if you have to remember that we're trying to impart useful information to the users of financial statements. So we've got debt investments trading. They're going to be valued at fair value on the balance sheet. They're going to always be a current asset because they're going to be sold within the near term. So when we're looking at our current assets, one item that we will have there for sure are going to be debt investments trading, because by definition they're current assets, they got to be there. With debt investments trading, the unrealized, we haven't sold them yet, so they're unrealized gains and losses, are going to be reported on the income statement under the category other revenues and gains or other expenses and losses. And that's where you're going to find, you're going to have your debt investments trading. That's where your unrealized gains and losses on income are going to be reported there, all right? So you've got your, you've got your unrealized gains and losses, income, debt investments, trading. Okay, so that's your trading. We've also got the available for sale. Available for sale, and this also applies to your debt investments. These are going to be valued at their fair value on the balance sheet. Your available for sale debt investments are going to be reported as current assets or non-current assets, depending on what management's intention and ability is. If they're planning to sell them within a year of the operating cycle, they would be under short-term investments at fair value. That's your debt investments available for sale. If they were going to be held for a longer period, they would be in the investment section on the balance sheet. Okay, so you got current assets, investments, and then you'd have property, plant, and equipment. So the investments category kind of falls in between those two. Now the debt investments available for sale, those we know that the unrealized gains and losses get reported on the balance sheet in the stockholders' equity section. So when we go up here to the stockholders' equity section, you're going to have total paid-in capital and retained earnings. So you've got you get your stock, you get your additional paid-in capital, you get your retained earnings and everything up there. Then you total your paid-in capital and retained earnings. And this is where you'd go less treasury stock if you had treasury stock. But this is also where you add unrealized gains on your available for sale securities or deduct unrealized losses on your available for sale. All right. So that's our trading and our available for sale debt investments. Now we got one more debt investment to deal with, and that's the held for maturity. That also can be short or long term. It can be short term if you're going to sell it within the near term. Management's intention and ability is to sell it within a year of the operating cycle, whichever is longer. Most of the time, your debt investments held for maturity are going to be classified as your long-term investments, just because the general intention is to hold them to maturity. But, eventually some will be coming due. And so as they come due, if they're coming due in the next year, then some of them would get pushed up to your current asset section. And so you'd have your debt investments held to maturity. All right, what else have we got here? Oh, stock investments. Okay, so we'll start with the holdings of less than 20%. These are the ones where you don't have any influence over the company. And so these are going to be reported at fair value on the balance sheet, and any unrealized gains and losses are going to be reported on the current income statement as an unrealized gain or loss income. So here's our stock investments, less than 20%. If we're planning to sell them within a year of the operating cycle, whichever is longer, they would be short-term. They also could be long-term if the management's intention and ability is to hold them for a longer period. Okay, and then we come over here and we've got our income statement, other revenues and gains, other expenses and losses, and here's our unrealized gain loss income, and here's the stock investments less than 20%. That's where that would get reported. I hope this is starting to make sense. Okay, let's see. Okay, now the equity method investments, these are ones where we have significant influence. We own 20 to 50% of the stock. We can't tell them what to do, but we can suggest things, you know, and they might want to listen. So these are going to be reported at equity. So these are going to be, by definition, in the investment section, stock investments at equity. So these are our equity investment ones, where we own, you know, like the 20 to 50% ownership. Now, if you remember when we did the journal entries for those, we had sort of a little different way of doing it. So when the company that we've invested in declared their income for the year, we would be crediting, we would debit our stock investment in that company, and then we would credit revenue from stock investment. That also is going to be reported on the income statement, revenue from stock investment, equity method. Okay? What am I missing here? Okay. Oh, and also in that other, while we're here, if we actually buy and sell, you know, this is where we sell the debt investment or we sell a stock investment, we would have actual gains and losses. These are realized gains and losses on the sale of debt or stock investments. And those would also be in the other revenues and gains or other expenses and losses section of the income statement, along with dividend revenue on your stock investments and interest revenue on your debt investments. So that's kind of a quick summary of where everything gets reported. I think you kind of have to work with that a little bit, probably do a few examples and, you know, just think about it a little bit to, you know, until it does actually start to make sense. One other thing the book mentions is comprehensive income. And this here is what they're talking about as other comprehensive income. So if you had to, if I had to describe comprehensive income, you start with, you've got your revenues less your expenses, that gives you net income. And so that's typically what you look for when you're seeing how a company's doing. But where we have unrealized gains and losses on our available for sale securities, comprehensive income wants to include all the changes in stockholders' equity except for owner transactions. Okay, so if you think about the stockholders' equity section, you've got your stock you've got your stock, common stock, preferred stock, your additional paid-in capital. Those are all owner transactions. Paying dividends is an owner transaction. So what comprehensive income is going to include, it's going to include all the revenues minus expenses. Those are summed up as net income in your retained earnings. Plus, it's going to include these unrealized gains and losses on the available for sale securities. Comprehensive income also includes other things that we have not run into yet, so we'll just kind of leave it at that for now. You just need to be aware of what other comprehensive income includes, which is all the changes in stockholders' equity except for your owner transactions. So that comes down to anything that's in retained earnings, which would be your net income. You know, revenues minus expenses get summed up when we close those to retained earnings. And then, it would be that plus minus your unrealized gains and losses on the available for sale securities. Okay, so that gets us through Appendix H, and we can move on to something else.